Hello, everyone. This is Peter Schultz. What we're going to talk about today is how to turn every Friday into a $1,000 payday by risking just $1,500, all while having over an 82 to 92% chance of winning. So before we get started here, let's introduce me. If you don't know who I am, my name is Peter Schultz. I'm the president of CashflowHeavenPublishing.com, and we have a company that's really just about 100% dedicated to figuring out how to increase your cash flow without taking a lot of risk and without really screwing up your lifestyle. So if you're an active trader and you really love trading and getting in the market every day and that's your thing, I don't want to take that away from you, but it's really cool to have something in the background going where you're generating a lot of really good income and almost the kind of thing that you can walk away from if you want to and it's still working for you. So that's pretty much what we teach. The main strategy that we're going to be addressing today is called the winning secret, and that's the letter I actually write myself. So how are we going to do that? How are we going to generate that income? And I also just want to let you know that I'm going to go pretty fast, and the reason I am is, I want to touch on all the good information, and then I want to have a chance to answer your questions at the end. So we're going to be kind of cruising here. But when it comes to stacking the probabilities on your side, there's no strategy in existence that gives you a better chance of winning than credit spreads. And if you know credit spreads already, you're a little bit familiar with the strategy, I just want you to hang with me and stick with me because we're going to talk about some things you may not already know and some ways to really dramatically increase your returns on credit spreads and actually lower your risk at the same time. So I know there's a lot of strategies out there. People like to teach a lot of different strategies. Sometimes it's really cool if you find something that works, gives you a really nice advantage, and just kind of a little vein that you can mine. And you can just get in there and just keep digging the gold out of that thing. And also, it's not too stressful and it's not too time consuming. And if you can get those two things in the same spot, I kind of think you're winning. So that's what we're heading for here. So, why is that? Why do credit spreads work so well? So here's a really good example. Here's a chart of the biotech index just recently here. And credit spreads are a lot different than any other type of trading. With credit spreads, you don't have to pick where the stock is going to go, just where it's not going to go. And that's a whole lot easier. So, if you're a trader, you're probably pretty familiar with technical analysis, and this isn't too complicated. This is just a uptrending support line that got broken on a lot of volume. That's a pretty good chance that it's not going to be popping back up above that trend line anytime soon. Old support turns into new resistance, and we're going to sell the spread above that. So basically, we're just trying to figure out where it's not going to go or where it's not likely to go. If you think about what the task is before you, if you buy an option, you have to have that thing move in your favor dramatically in a fairly short period of time to make any money. So your direction has to be right on and your timing has to be perfect. I cannot tell you as an options trader, and I've been trading every single week in the markets for over 20 years, options exclusively. I cannot tell you how many times I've been right on direction and the stock made the really big move that I was hoping for the Monday after Friday's expiration. And that's some pretty cold comfort that you're quote unquote right, but you end up losing money. And so, it's just, if you can do that and you can do that successfully and you're good at it and consistently, I take my hat off to you. You've obviously honed your skills. Personally, for me and for a lot of folks out there, you just need an edge. I mean, you need something that's so stacked in your favor, you can kind of screw up a little bit and still win. And that's what I love about this. You don't have to be just a trading savant every single day. And that's nice. So why does the strategy work so well? Because before, close maybe only worked with horseshoes and hand grenades, but now you can add one more to that list because with credit spreads, close is good enough. You don't have to be perfect by a long shot. You'll be surprised how many times you trade this and you're a little off on the direction of the stock and you still won because so much is working in your favor. So with this kind of trading, you'll automatically win on 4 out of the 5 things that a stock can do. And I'm going to just get my little pointer here, and let's just say, what did we do here? Let's just say, this gap down a little bit, and we think it's going to show some weakness here just based on the chart. And so we sell, we go up here and we sell a call spread, right? So we're setting up our spread up above where the stock is right now, and with the assumption that our spread isn't going to get touched anytime before expiration. And another thing that I absolutely love about this strategy is you always know how long you're going to be in a trade. You know, you can certainly exit early, but you have that expiration date, you have that finish line. So you know come hell or high water, you're going to be out of the trade at a certain date. You don't really have to worry about that. So let's say we set up a credit spread above the stock, and there's only 5 things the stock can do. So the stock from here can drop. Some bad news can come out. It can completely fall out of bed. It can go straight down. We've all seen that happen. If that happens in this scenario and you have a call spread up here, you win. The stock can dribble down. It can go down here to this 155 support level. It can kind of bobble along that. It can kind of go sideways. If that was to happen, if the stock was to go down a little bit, you would win. If the stock from here just kind of trades sideways, it just kind of goes up and down and trades sideways for a little while, you win. If the stock goes up, you can see where it's kind of hit this support level and it's sort of trending up kind of slowly a little bit, but our spread is way up here. If that was to happen, you still win. So the only scenario out of these 5 that you would lose on is if all of a sudden the stock got a wild hair and decided to shoot straight up. Now, if you think about options buying strategies, when you buy an option, say you're going to buy a call up here, there's only one scenario out of those 5 that you're going to win, and that's if the stock shoots straight up. And people, you know, it's really, really interesting. I've been dealing with and talking to and coaching and mentoring options traders for, like I say, over 20 years, and it's amazing how many people I've talked to that said, you know, I did everything right. I looked at the technical indicators. It was the perfect trade. All the indicators were set up. I mean, this was textbook. And this happened and that happened, and I still lost on the trade. And I go, I know. That is dang frustrating. When you set up everything the way that you've been taught to be, it's all perfect. It's exactly set up. You know, you're practically counting your money as you're entering the trade, and the thing blows up in your face and it doesn't work. If you're wondering why that happens, if you've gotten a little bit frustrated, if you're going, what in the hell is going on here? This is why. It's really, really basic. It's essentially when you buy a short-term call or put, you have, you know, just real basically a 1 out of 5 chance of winning. When you sell that, when you sell something out of the money, the stock actually has to do something extraordinary. If you think about it, in order for you to lose. So if you think about it, if your call spread is up here, it's got to, you know, it's got to reverse this gap, it's got to fill the gap and then keep right on going and overrun your spread. And, you know, just chances are that's not going to happen. So, you know, you just have this really nice scenario where all other things being equal, you win. So that's nice. So all that has to happen to make maximum profits on a credit spread is for it to go to its expiration date without having exceeded your sold strike. So, you know, here's a good example. This is probably going to bobble around. A lot of the time these reverse, they bounce back up. They'll hit this, what used to be support, now turned into resistance, and then they'll turn back down. A lot of people, when this touches, starts to turn down, they short. It's a good place to short. You don't have to be that active. This thing just sits there, loses time value, melts time value into your account every single day. I'm going to show you the perfect amount of time to sell for a credit spread. You're going to like this. This is going to be some good information for you. So when you sell an out of the money option, what you're really selling is time. All you're selling is time. And time, of course, has value. But as that time runs out, so does its value. So let me give you an example here. This is pretty interesting. This is an actual trade we did. This is the actual recommendation and the write-up that I put in the chart. And it says the IBB 327, 350, and 330 call spread was sold for 45 cents with 9 calendar days left until expiration. With 7 days left, in other words, just 2 days have gone by, the same spread is just 17 cents. So that's a 62% loss of value in just 2 trading days. And that loss of value came from a combination of time decay, a little bit of time decay, and moving slightly away from those strikes. So when you're this kind of close to expiration, a little move in your favor goes a long ways, and because you're so close to expiration, you're getting quite a bit of time decay every single day. So you just picked up 62% of the value of that spread that you collected in just 2 days. You could actually close it out right there, call it a trade. If you like trading short term, if you like collecting profits a lot, and you like having a really good probability of winning, I think you're actually going to love this. And you know what's amazing to me, and you're going to see some kind of exciting things here with credit spreads. What's amazing to me is a lot of traders that really like the action of the markets, and they like the action of the volatility. They like getting in and getting out. They say, well, credit spreads, why would I want to do credit spreads? Credit spreads are boring. And I would say, you know, it's all, number one, it's all in the eye of the beholder, and number two, not the way we do it. So there's a lot of ways to skin a cat. So just stick with me here, and I'm going to show you some cool stuff. So there's three main factors that determine an option's value. There's a lot of factors. If you're in options trading, if you're into the Greeks, you know, there's a lot of stuff. You can really get into it in depth. But I'm going to just really simplify this real quick, and I'm going to say time. So that's the days till expiration. That's the time value of an option. How close the strike is to the stock price. So that affects the value quite a bit. And number three, how volatile the stock is. So the volatility of the stock, the implied volatility, determines the time value of the option. So obviously with more volatile stocks, you're going to have more expensive options, and that makes sense. So let's just take a look real quickly at all three, and let's see if we can kind of get those three main factors of an option's value to really stack the deck in our favor. So let's first talk about time decay. So the time value of an option does not decay in a straight line, and we want to use that to our advantage. So just real quickly, you'll see that, and this is 3 months out. Get my pointer. So so this is 4 months to 3 months, and the time decay is fairly flat. And if you're familiar with options, you kind of know this. 3 months out to 2 months out, it starts to steepen up very slightly. 2 months out to 1 month out, it actually, there's a point here where it's going, kind of the option is transitioning from second month out to front month, and that time decay starts to steepen up a little bit. But look what happens in the last 30 days. The time decay, I mean, almost starts going straight down. This is where you get a lot of benefit from selling options. Now the trick is to sell enough time to get the premium that you want, get a lot of premium. But when you do this, the time decay is really, really, really working for you. Now, if you've had the experience of buying short-term options, your life has never gone faster. Expiration looms in the windshield very, very quickly. The opposite is true when you sell an option. You know, that time going by is just totally to your benefit. And I've seen a lot of trades come out in our favor just because of that benefit. You know, maybe we weren't exactly right on the direction. Stocks bobble around. They're always offering you surprises in their movement. But you have this portion of the time decay curve working for you, and you'll be amazed at how often you win. So options used to expire just once a month. If you've been around for a while, you know that, on the third Friday of the month. But the Options Clearing Corp and the SEC made some big changes to options in the spring of 2012 when they allowed weeklies on certain stocks and indices to have expirations every Friday of the month. Now, if you're into selling options, or if you're just into options, period, you know, these weekly options have just absolutely changed everything. You know, this is where we can set ourselves up for a payday every single week, every Friday. And if you've been paying attention to the SPX, you know that now there's options expirations on the SPX on Mondays and Wednesdays and Fridays. So it's just, I just want to point this out because we've got more opportunities to profit than we ever have. You can do more things with time decay, diagonals, playing off of those time periods than we ever have before. The bid-ask spreads are more narrow than they ever have been before, and the commissions are lower than they ever have been before, and we've got more things to trade. So it's just never been a better time to be an options trader. It's an amazing time, and there's a lot of things we can do with these new expirations and products that they've come out with. So let's just concentrate on Friday right now with time value. So Friday is payday, and we can now get that payday 52 times a year in a strategy that's fairly passive that you can do without a lot of stress. So that change gives us two super big advantages, and we just mentioned that we can now sell an expiration for every Friday of the year if we want to. Pretty darn nice. And you know, if you think about it, this is the kind of income that can get you to retirement. I mean, if you're getting paid a decent amount of money every Friday, and you can do that from anywhere in the world, you can get an internet connection, you know, that's kind of an exciting concept. It doesn't take much to get your imagination going. So number two, which means we can sell on the perfect point of the time decay curve. So that's That's actually a really important factor. So let me just tell you what that is. And if you're into taking notes and getting some good information here, you're going to want to take this one down. So we've done a lot of studies about time decay, and it's a balance between getting really good time decay, rapid time decay, having every day working for you, and getting enough credit to make it worth your while. So what we found is that 1.5 weeks of time to 2.5 weeks of time, and this is calendar time, is the optimum amount of time to sell. So I do a big update every Tuesday night, so we're going to place our trades on Wednesday morning, and we're going to enter those. Sometimes we get filled that Wednesday. Sometimes when we have a good till canceled order, we'll get filled the next day or the next day. But if we get filled on Wednesday, that's 9 calendar days till expiration because it's expiring the next Friday. But if you actually count up trading days, so days that something could happen, actually days where your money is at risk, you've got 5 days in the next week, and then you've got the Wednesday, Thursday, and Friday of that week. So that's actually, 8 days of time, the 5 in the next week and the 3 in the current week. So that's only 8 days of time that your money is exposed. Okay, so you think about that. So that's selling right about here on this time decay curve. That's, look at this drop here. That is some really, really, really rapid time decay. So that's why you just have a tendency to win. Now, if during that period of time, if any time during that period of time after you get filled, the underline, whether you're doing the SPX or a heavily traded stock or whatever, if that underline moves in your favor by just a little bit, moves in your favor by just a couple of points, because of the combination of the time decay and moving in your favor just a little bit, you can see a huge amount of value of what you just sold just melt right into your account. And like I say, you can close it early if you want and lock in a gain, and that's not a bad strategy. And you can just go ahead and do it again if you see a good opportunity, or you can let it go to expiration. And we do a little bit of both. And I'll give you some rules on that. So how close do we sell? Where do you place your spread? So obviously, sell your calls above resistance. This is pretty basic stuff. And sell your put spreads below support for the amount of time that you have left. So here's a trade that we just did this last week. This is Dollar Tree. And here's the write-up on it that I put in the update. This has one of the most consistent uptrends going right now with good horizontal support just above our spread. So here's the horizontal support. This is short-term horizontal support. And we're going to sell right below that. So we're selling below horizontal support. We're selling below uptrend support. Earnings came out right back here, in August. They were excellent. This company has really good demographics. They're one of the few retailers that's actually Amazon-proof out there because the stuff in their stores costs $1. It's one of my favorite stores. I can go in there with $10 and feel like a millionaire. And they're doing great. And they've got like 1,000 stores, 1,400 stores around the country. You can read about them. We do a whole write-up on these guys, but everybody loves them. And they'll even do really well in a recession because everything's so cheap. So here the stock is going up, performed pretty well. This is what officially we did in our Tuesday night update. So we got a few days since then, and it's just bobbled along going sideways and just kind of generally going higher. This trade does not require a lot of maintenance. My anticipation is we take a big nap into expiration and the thing expires worthless. We're getting, for what the credit we collected, we're getting a 25% return on this trade in 8 trading days. You get those kind of returns that often. Get out your calculator and do the math. You're going to be a zillionaire. But obviously, every trade doesn't work out. I'm just letting you know these returns are pretty decent. And if you pick the right trades going the right direction, it takes a lot of the risk out of it. So in addition, sell your spread so they have at least an 82% probability of winning. So options are based on either the Black-Scholes options pricing model, the original pricing model, or there's some other pricing models that have corrected some of the deficiencies of the Black-Scholes that they actually use now. You don't need to know this math to make money on it. What I tell people is you don't need to know all the inner workings of the internal combustion engine to drive your car to the bank. You just need to know where the gas pedal is, the brakes, the steering wheel. You need to know how to drive. And so we take advantage of this options pricing model to really increase our probabilities. And to take the guesswork out of that, Well, let's see. So here, I'm just actually showing you a trade. So this is a trade we did a while back, and I want to show you the probability of winning on this. So this is the trade. It popped up here. We got filled. It kind of reversed a little bit. We're planning, you know, it's hitting this resistance level. We're planning on it turning over. But if we want to know the probability on this trade, 82% is kind of our bottom. We want to have that or better. Oh, and I just want to mention, well, let's just take a look real quickly. How do we know what our probability of winning is? So if you use the Thinkorswim platform, or if you have any kind of options trading platform, with Thinkorswim is really popular, so I'm going to address this one right here. This is the one that we use. Love it. And so they've got this layout tab right here. So you click this bottom right-hand corner, and it tells you what your column headings are. And you can set this up any way you want. So this is probability of being out of the money. So this particular trade, what we're concerned with is the option that we sold as part of the spread, the part that we sold. So what a spread consists of is you sell an option, you buy another option to hedge. So what we're concerned about is not having the option that we sold get touched by the underlying. We never want the underlying stock or index to go into our spread, because at that point you start losing money fairly quickly, and we don't want that. So if you look at this, this is the this is what we sold, is that particular option, the call. And we look over here, the probability of being out of money at expiration, that is the top of this column right here. You go down here and it's an 88.47% chance of winning. So, you know, between 88% and 89% chance of winning. So actually substantially better than 82%. So I have a question for you right now is, do you know on the trades that you're doing right now, and I assume you're an active trader, at least interested in trading, on the trades that you're doing right now, what is your percentage of winning? And I'll tell you why this is such a big question. This is what the pros ask themselves. When you first get involved in trading, particularly options trading, you get these big starry eyes about how much money you make. And when I first got involved over 20 years ago, you know, I saw how these options doubled, tripled, you know, I saw the crazy stuff that went on. And I thought, you know, my biggest problem in life is going to be what color my Mercedes-Benz is going to be. And then I started getting involved in it, and I'd buy these low-cost options, you know, close to expiration. I kept losing my money. I go, what the hell's going on here? What the heck is going on? You know, I'm really, really frustrated. And what I realized is what the pros, the people that make money consistently ask, the question they ask is not how much money can I make, but what is my probability of winning? What is my probability of winning? You stack the probabilities in your favor by 82% or better on all of your trades, and I'm just telling you, I know the market has a lot of surprises, a lot of volatility, but it's going to be very difficult for you to lose money over the long run. When you stack the deck that far in your favor, you are, you know, all other things being equal in this random crazy world we live in, you're probably going to make money. You're probably going to do pretty good in spite of yourself. Even if you haven't made a lot of money in the past, even if you've had a lot of mistakes and you've taken 2 steps backwards for every 1 step forward, you make this one little change in your trading, and I predict that you're going to end up doing pretty well. Okay, so the next subject, we're getting off of time now, we're getting into volatility, is how do we use volatility to our advantage? So here's a chart of the VIX, classic chart. People talk about the VIX a lot. The VIX is essentially the volatility measurement on the S&P 500. So this is where people talk about, you know, volatility is lower, volatility is high. What I think is interesting about the word volatility is it's a little bit of a misnomer, because what they really mean by volatility is the stock market going down. Because the stock market can gap up, it can go straight up. We've seen some incredible movement in the markets in the last couple of months straight up, and the volatility is low. And that means the time value of the options on the S&P 500 are low. As soon as the market crashes, you'll see this thing spike. So the key is to sell credit spreads in times of high volatility, and that can be relatively high volatility, transitioning into low volatility. Volatility determines time value. So collapsing volatility, this is a really interesting concept. I want you to think about this. If you're an options trader, collapsing volatility synthetically shortens the time to expiration in terms of value of the option. So let me explain that a little bit further. Let's say there's 2 weeks of time left till expiration, and you sell an option and you collect a certain amount of money for it. In your mind, you're going, well, expiration's 2 weeks away, so I kind of have to wait. I have to wait for this this time value to sort of melt out of the options in order for me to collect, what I want to out of this trade. But if volatility suddenly collapses, and keep in mind, all we're selling is time value. We never sell in the money options. So all we're talking about here is time value. So volatility determines the value of time. So if the volatility collapses, the time value simultaneously collapses, and that can happen in one day. And we've all seen it happen, and I'll give you a really good example because, earnings season is where there's a lot of action in the market. There's all of this volatility priced in the options right up into when earnings are announced on that stock. The day after the earnings are announced, or 2 days after the earnings announced, the volatility has just gone out of that option like the air coming out of a balloon. And so you can take a week's worth of time, and that time value, that week's worth of time value can evaporate, can disappear in one day. Now, if you're a time merchant, if you're a time seller like I am, and if you're a trader, you're an options trader, even if you're not an options trader, get into this. Take a look at this because it's really, really cool. If you're a time merchant and you sell time, you want to always sell expensive time and buy back cheap time. Or you can just let the thing expire, but the thing is if you've realized the vast majority of the potential profit of a spread in 2 days after you make the spread, why sit around and wait for a week for something bad to happen, for the market to go crazy, for one of these crazy, look at this spike. The thing spikes from under 9 in 2-3 days, it goes all the way up to 17. And this isn't even extreme. This is just this low volatility period that we've seen for the last few months. Things could go crazy. We've all seen it. Something happens to do a geopolitical event or whatever, the market goes haywire. Why wait around for that? Take your money and run. So this is a really important concept, how volatility determines the time value of an option. All we're selling and buying is time. So let's really use that volatility to our advantage, and I can actually show you how to do that. So one of the great things about high volatility is it doesn't last too long, as this chart of the VIX shows. So if you sell high volatility up here or up here, boy, it collapses quick. We had a little spike the other day. It didn't even last the whole day. Reverse that same day and comes right on back down. And if you look at these, these numbers here, these are huge percentage changes. So we've gone over 13 on the VIX just 3 days or so ago, or just a few days ago, down to, below 9 again. So if you're selling volatility, you don't have to usually wait too long. The market seems to have a really low tolerance for sustaining fear, which is probably a good thing. It can sustain complacency forever, but fear, short amount of time. So now we know we've covered these 3 big points. Now we know how to use our time to our advantage, by selling on the right part of the time decay curve, knowing where to sell our strikes, and knowing how volatility affects the time value of our options. So how do we put it all together to create $1,000 paydays on any given Friday by risking just $1,500? And I assume that's why you're watching this. So that's what we're going to get to right now. And having over an 82% chance of winning to boot. So let's take a look at some trades. The key is knowing what we can make going in, analyzing our probability of making it, and defining the most we can lose if the trade goes against us, and that's important. So let's take a look at some of our trades. As you know, if you're a trader, if you've been around for a while, managing your potential losses is super, super important. So, I mean, it's great we're stacking the probability in our favor by 82% or whatever, but what happens to that other 18% or whatever it is where we do have, something that goes against us? How do we handle that? So here's a trade. Here's a recent chart of the S&P 500, and this is the, this is the write-up on it. And so what we did is we're setting up a condor here. So here's a call spread up here, and here's a put spread down here. And we actually got filled on our the put side. So we had a little bit of a pullback the next day. If you've been watching the market, you kind of seen this. Pulls back, fills our put spread. Once again, we're selling this put spread underneath a couple uptrending lines of support and some horizontal support. And so we want to get our put spread down here where we don't think the index is going to go. So we're selling away from the direction of the put spread. did not get filled on the call spread in this particular case. And this is an actual trade. So in this case, we collected 90 cents or 1,200 on 10 contracts. But so what we're going to do here is we're going to set up a stop, an automatic stop loss, so that if our sold strike is touched, if we wake up one morning, there's a big gap down, there's some bad news that has hit the headlines, and somehow this index gets down and touches our sold strike, we're going to close the spread. Now, the delta theory tells us that when the stock or the index, the underlying, is right at our strike price, the delta is going to be 50.50. That means the option appreciates 50 cents for every $1 that the index moves in that direction. So options theory also tells us that if we close the spread, it's going to cost us, the amount it's going to cost us to close it is exactly half the distance of the spread. So in this case, this is a $5 spread, $5 distance between these two strikes, so it's going to cost us $2.50 to close it. And that's going to all happen automatically. We could be sleeping, we could be out walking the dog, we could be vacationing on the other side of the world. This is going to happen. I'm going to show you how to set up automatic orders so you don't have to, hover over your trades and watch so close. So we collected 90 cents or, actually 900 on 10 contracts. That 1,200 is not correct. And so we're going to subtract, so the most we can lose is 2,500. And so, well, let's just get to the next screen here. So it's 900. So we collected 90 cents or 900 on 10 contracts. To protect ourselves, we set a stop right at our sold strike. And we went over this. Option theory tells us that we close right at the strike, the delta will be 1/2 the spread or 250. So on 10 contracts, that's a potential loss, what it would cost us to close it, of 2,500. But we already took in 900. So you subtract our $900 credit from the 2,500, and now we're making 900 by risking just 1,600. So in our goal to bring in $1 or $1,000 by risking just 1,500, we're pretty close by selling just one side of that spread. So in this case, we're bringing in 900 and we're risking 1,600. Now, I know people tell us, well, your real risk is the entire margin, and that is theoretically true. You could have a gap that goes completely past your margin and you could lose the whole thing. That rarely happens. So look how far away we're selling, look at the direction. So what happened is we entered this trade and we're kind of back here. And what happened is we got a quick little spike down one day, and this is a 60-minute chart, so I can kind of zoom in on this trade. So this is a day's worth of trading here. It dropped really quickly. It got us a pretty decent credit on this 25.35, 25.30. We brought in 90 cents, but the way the market has been acting, one of the reasons I'm so confident in selling put spreads right now is the market, these dips tend to get bought fairly quickly. Now, of course, at some point the market sentiment is going to change. That's going to change, but right now this is working really well. So this thing spikes down, it reverses this one day. These candlesticks tell us that we're going to have a really nice reversal. That's exactly what happened. So and you can see the days down here. So we got filled right here on the 25th, and just 3 days later, this option that we sold for 90 cents is going for 22 cents. So, I mean, we could close it out right there and make quite a bit of money. Just a couple days later, we're going to hang on to it for a little bit longer. But the point is we're risking 1,600 to bring in 900. That's a pretty nice rate of return for a so-called boring strategy. But, and here's the breakdown on the math. So in credit, we brought in 90 cents. Our margin hold, now the amount, and this is what we actually based our percentage returns on the site when you go look at our track record. We're going to use the full margin hold. So, it's going to not look quite as good, but the rate of return won't look as high. We want to be conservative on presenting our rate of return. But what I'm really talking about here is how much money you have at risk, because you've got this automatic stop loss working for you. So we're going to set our stop at our sold strike. So our risk is 250, half the distance between the spreads. We subtract the credit. The actual risk is $1.60 on bringing in 90 cents. Well, if you do the math, that's a 56% return. That's like pretty incredible. Now, if you look at this on the website, we'd only show 21% because we would be dividing the 90 cents by the full margin. But what we're talking about is how much you're risking to bring in this money. So let's take a look at another one here. So this is a new trade that we just did this week. So we sold the 24.40 puts and bought the 25.35 puts for 90 on this dip. Okay, so we took in another 90 cents. So that would have been a 21% return all by itself, and we showed the risk on that. But what the other thing that we did is, no, actually this trade just expired on Friday. That's right. So we just finished this one. So when the index, so we sold this side here, when it spiked up, you know, our indicators, and one of the reasons this works so well is I have a really good set of proprietary indicators that tells us and tells me when to recommend putting on these trades. And I send you an email, I send you a text on your phone, and I also post it on the site because I want you to have this information right away. And so we have this chance to sell this call spread up here, and we entered our orders for a minimum of 60 cents. We actually collected 70 cents. We kept, you know, this trade open here, so this one doesn't cost us any more margin because the broker's already holding the margin on this put spread. This one doesn't cost us any more margin. We don't have any more money at risk, but we just took in another big chunk of money. So we ended up getting 70 cents on this side. So let's take a look at the math on this. And this is not hypothetical. I mean, this is a real trade we just closed out of yesterday, just expired. And so our reward is, so what else we did is when it dropped down, so this peaked, came back down here. I didn't think it was going to really threaten our spread, so we kept this open. But what we did is we closed, when this got all the way down here, we had the opportunity to close this spread right here for just 5 cents. And our rule is, and this is another thing that you can write down, is our rule is that if the spread gets, and this is on a $5 spread, if it gets down to 5 cents or less before the last day of expiration, just automatically close that trade. And I will also show you how to set that order up. So you have your stop loss in place to automatically close if your sold strike is touched, and you also have another order in place, and you can do all this on the Thinkorswim platform. It's so unbelievably cool. They've spent millions and millions of dollars honing this platform. We get to use it for free just by opening an account. But we have an automatic order in here where if this trade gets down to 5 cents, this automatically gets closed. So all of our risk is removed. And that was a good thing because the index bounced radically higher. Good earnings came out on all the big techs Thursday night. Friday morning, the stock the index gapped up again. For all I know, the markets are crazy. It just could have kept right on going and threatening this thing. But we didn't have to worry about it because we were already out of the trade and we closed for just 5 cents. So instead of keeping the whole 70 cents, we gave up just a nickel and we ended up keeping 65 cents on this side, on the call side. With the index zooming straight up, we never had a really good reason to close our put spread, so we ended up keeping the whole 90 cents on that one. That expired worthless yesterday. So you add the 65 cents that we netted on the call spread to the 90 cents that we netted on the put spread, and that's $1.55 for what ended up being just 7 trading days of time since we very first opened this trade on the put side. So on 10 contracts, that's $1,155. But what's our risk? Let's always take a look at our risks. It's really important. Once again, to limit losses, we set a stop loss right at our sold strike, or $2.50 on a $5 spread, $2,500 on 10 contracts. So our credit is $1,155. So if we subtract that from $2,500, it comes to $1,345 in risk. So we actually made more than $1,000. We made $1,345. And we rest with less risk than $1,345 in risk, so that's less than $1,500, and our $1,155 is more than $1,000. So we actually exceeded our goal here on this particular trade simply by doing 2 things. Number one, we sold when it was really advantageous to do so. We opened our put spread here. Indicators told us this is going to turn around. We're below support, so we had no problem opening this. And then when it spiked up here, it looked like it was going to turn over. We sold our call spread, collected a really nice credit there. So timing of these spreads is super, super important. And so we actually end up making more. We've got a short period of time, so time decay is really on our favor. We've reduced our risk, and we've actually made a pretty good return. So let's take a look at what that is. Let's see, here's the math for a $5 spread. So we bring in $1.55, our margin hold is $3.45. We set our stop right at our sold strike, so our risk is $2.50. And we subtract our credit, so our credit in this case was $1.55, so our actual risk is 95 cents. So if you're thinking credit spreads are kind of boring or kind of low return, look at this. We're taking in more credit, we're taking in more potential profit than the amount that we're risking. So, you know, if it was the same, that would be 100% return, but we're actually taking in more. So if you do the calculation, if you take $1,155 in profit on 10 contracts and you divide that by your $950 in risk, that's 121% return on a strategy that is totally stacked in your favor. I think in the trading world, frankly, I don't think it gets better than this. I think this is kind of amazing. You know, you probably got some strategies that you do and that you like, but I mean, my goodness, this is incredible. So my question is, and you know, I've been doing this a long time. I love credit spreads. I've got some really good indicators that really stack the deck in our favor. I communicate with you really well. We have excellent education. I'm going to talk about that in just a quick second. If you really don't know the ins and outs, I really want you to get up to speed. So my question is would you like to bring in these kinds of credits with my help? And I would love to help you. Nothing makes me happier than seeing people get successful and be successful, especially if they've been a little bit frustrated with their trading in the past. So these credits are especially generous when you consider your high probability of winning in the short time until expiration. Now, all markets are different. You know, this has been a fantastic market to trade in. I've absolutely loved it. Sometimes, you know, we just pick up 60 cents here and maybe 20 cents on the next one or whatever. So, you know, maybe we get a 14% return based on margin. We're shooting for about 25% based on margin. So if we get $1 on a $5 spread, that's a $1 potential profit on a $4 risk if you consider the entire margin as risk. And we do when we post our track record, because I think that's the fair thing to do. I think you have to do that. I think you have to consider that. And that margin's being held in your brokerage account, so that money is tied up. So that's what we do. So if you collect $1 on $4 of risk, that's a 25% return. But if you take a look and realize that you're only risking 15%, or excuse me, 1,500 instead of 2,500, your rate of return gets a lot better. So if you would like some help with this, if you'd like to learn how to do this, and like I say, no matter what else you're doing with your trading, do this with some of your lower risk trading money. I think you're really going to like it. And I'm going to show you some numbers in a second that are going to kind of blow you away about what you can potentially make. Here it is. So if we start out with just a $10,000 account, what does our money grow to at just 5%? So why am I using 5%? Because number one, we hold some cash back for buybacks, for rollouts, for adjustments. I think that's really important. We actually hold about 40% of our account in cash, and we're only trading about 60% of our account. So that's one reason that our total return gets reduced, is we're not trading the whole account, which I think is really important. And number two, you know, this is like any other kind of trading. Occasionally that sold strike is going to get hit. The market is going to do some crazy surprise. It's going to reverse. Even with the best chart and the best technicals, you're going to have to close out of a trade. So you have to factor in losses, and we do that. If you go to the website and look at our track record, we post all of our losses. We're the only advisory out there, I think, that posts our complete track record for you to look at. Nobody else does that. I think other folks don't do it for maybe obvious reasons, but you're going to see losses, but overall we win. So what I want to do is I want to take our expectations and dial them way back. So we're getting 25% per trade. A lot of the time we're getting a lot better than that, but let's just say all we can manage is 5%. So after 2 years, 10,000, and if you're doing this and you're getting this income every couple of weeks, 10,000 has grown to 104,000, over $104,000, and you're bringing in over $10,000 per month. Now, if you're looking at this chart right now, it's pretty incredible. It's almost, you know, parabolic the way that it moves up. You're probably thinking, well, Peter, listen, I have been trading in the markets for a while and nothing works like this. Nothing gives you this even money. You have, you know, you go forward, you go backwards. Sometimes the market's volatile. The market throws you surprises. You know, you'll have a little short, little losing streak before you start on your next winning streak. You know, it just doesn't look like this. I realize that. I realize this does not represent the real world. But what I did do is dial it back to a very, very minimal 2-week return that I think we can easily make. And you can have a reasonable expectation of making that. Or doing better. We've actually averaged better than that. And just kind of what the whole point of this exercise is, or showing you this graph, is really the power of compounding your returns in a very short period of time, every 2 weeks instead of, you know, once a year or whatever. And if you're looking to really grow your account and grow your income and potentially retire off of your trading, I mean, I can't really think of a better strategy. This is amazing. So let's see how we can help you do that. So first of all, I think this is a strategy you really can't afford to pass up. I mean, if you like to trade, and especially if you like to win, I think you're just going to really get addicted to this. It's wonderful. But even if the timetable doesn't work out perfectly, like on the graph we just saw, what if it even comes close? And look at what you've learned. How to make money from anywhere in the world you can get an internet connection. That's a lot of freedom. I've made trades in a corner little coffee shop in Amsterdam. I've made trades traveling through India, you know, getting an internet connection where I can. You know, I've made trades in the Caribbean. It's just a fun thing to do, to travel the world and make a couple of bucks while you're doing it. So the key to making this work is, of course, knowledge and having the confidence to really know what you're doing. So it's super important for me that you're successful with this strategy. So I want to make sure that you have everything you need to do really well. So I've been putting together some pretty incredible information, and I think you're going to be kind of amazed to see everything you get. First thing is this trading package, and that's called the Winning Secret. It's dedicated to more income more often. You'll see how wide of a spread to sell, how much time to sell, what to do if the stock starts getting close to your spread, how many spreads to have on at one time, plus a big section on adjustments. Everything you need to trade this strategy with confidence. I want you to have really, really, really good information. This is the breakdown. You get a 161-page downloadable ebook. You get 15 chapter video series. You get 14 separate audio files. You'll have access to all of our archive webinars. I've got really good webinars on money management, how much to dedicate to each trade, you know, when to get in, when to get out, adjustments. And you'll have access to all of our new webinars for life as an owner of this package. So instead of getting some book that sits on your shelf and collects dust, this is being updated. I'm adding new information, and it's one price. It's a reasonable amount of money, and you'll have access to this for life. You know, you'll have a password. You'll be able to get in, and you'll be able to see, you know, all the education that's there and all the education that we're going to add. And I really, really like that. So you'll have access to the education. In addition, you'll get 3 videos that show you how to set up automatic orders with our favorite broker for spread trading. And these are the videos that show you how to automate your trades so you don't have to constantly monitor them, providing peace of mind knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. To me, there's really 2 parts of trading. We get into it to make money, but if you don't have, if it's not conducive to your lifestyle, I don't think you're going to stick with it, and you're certainly not going to enjoy it. If your trading is stressing you out, if you're not enjoying it, if you're having to watch your trades too much too often, if you're glued to your computer screen, if which way the market is going is sort of dictating your entire mood for the day, I think you really need to, as human beings, we kind of need to back away from that a little bit and get into a little bit more passive, but still incredibly effective way to trade. And that's what this is, and this is why I like it so much, and I like to introduce it to others. So this is the subscription part, and this is kind of where the rubber meets the road. This is the big write-up that I do Tuesday nights. We go to place our trades Wednesday morning, plus I give you updates during the week, you know, when we should maybe take our profits off the table, when there's a new opportunity that pops up. It's really, really fun. And I love writing this. I love us making money together. I love getting into the market, love taking a look at those indicators, and I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. And so this is really cool. Now this all by itself is $97 a month. you know, you're probably going to make that back on your very first spread trade. In fact, a lot of people have made enough on their first trade to pay for the whole year. So I don't think that's really an issue. I've always thought that the market should pay you for your subscriptions and your education, and you shouldn't have to pay for it out of your pocket. So this is what this is really designed to do. I think you're really going to like it. I think it's fun to make money together, and that's how we do that. As an extra bonus, I'm going to throw in a free 10-module video course and digital book just on trading the weeklies. This is probably one of the most popular courses that I've ever produced. Everybody wants to buy it all by itself. What I've decided to do is bundle this in the package, so you just get, you know, I'm just going to throw everything at you, the whole kitchen sink, and it's cool information. The weeklies have really changed things, especially for us time sellers. And I want you to be able to trade with a broker that has the best chance of making you money. So to make sure everything you've got going for you possible, you'll also get a special link to open an account at the best broker in existence for this strategy. That's Thinkorswim. And once you have you've opened your account and you've come on as a subscriber, we'll put you in touch with our dedicated team at TD Ameritrade and Thinkorswim to get you special commission rates to save you money while you're learning. So while you're learning, if you're only trading 1 or 2 contracts at a time, we're going to save you a lot of money on your commissions. And then once you ratchet it up, you can go to a different program. But this is kind of our way of making sure that you make money in the beginning and commissions don't eat up all of your profits, so you stay enthusiastic and stay profitable. I also want to get you a lot of special individualized attention. So if you come on, I'm going to have you meet with Deanna one-on-one over the phone or over the computer. And she's going to make sure you're set up correctly, including getting the best rates at the brokerage account. You know, she's going to walk you through a trade. I don't want you to be confused. I don't want you to try and figure this out on your own. Even though it's not super complicated, it's really nice to have somebody hold your hand. She's an absolute sweetheart. She's got a lot of patience. I think you're going to like her. I get a lot of really, really good feedback on her. You know, everybody just loves her. She's great at what she does, and she's going to kind of take you by the hand and walk you through just how to get started, you know, how to get the best out of the information, how to make your trades, what a spread trade looks like, so you're not, you know, you're not confused, you know, you're feeling pretty good about things. Then I got something else. Now Alicia here is just an absolute genius. She graduated at the top of her class in finance. Fortunately, I live in a town with a really great university in it, and I actually hired her. She's been amazing. We have a lot of fun going over option strategy. She's my coach, mentor, and she, you know, she does 45-minute sessions for about $350 per session. She's booked out all the time. People absolutely love her. People schedule 8 sessions in a row. They get a little bit of a discount. But I want you to get a session with Alicia. So once you've talked to Deanna and you've got all your accounts set up, you're all ready to go, you know, you're pretty familiar with everything, your session with Alicia is going to actually get into strategy where you can actually see some ways to really make some good money and how we tweak credit spreads to really work them in our favor. Alicia's fantastic. I love her. You're going to love her. She's great. She's sharp. And she's, I think, really helped people make a lot of money. She's great. And that I'm going to include with this package. So this is absolutely a train you can't afford to miss. I'm going to give you a URL right now where you can go and actually sign up. And this is just everything that you get. Your URL is 1000, and that's the numbers 1000 dash. You got to get the dash in there. That's really, really important. And then payday.com. So go there, you'll see everything. I've sold this package for over $2,500 at live events and workshops, cruise ships. I still get emails from the people that bought it for that. They're still really thankful. You're not going to pay anywhere near that. If you price out all the individual things we just talked about on our website, you know, this would be a couple $1,000, $1,500, somewhere in there. It's a lot of value. And I'm going to bundle it down into something that you can afford and probably make back on your first trade. So I want to give you a really good value there, but we've only got a few minutes. I actually want to answer some questions. If you have questions, I'd really be delighted to answer them. And let me see. Let me see our questions here. Where do my questions start? Well, let's just get down here to the bottom. Okay, how many trades are SPX? Can I use SPY instead? That's what Dave says. Yeah, you can use SPY. I prefer XPX. We tend to, at the same price on both of them, we tend to get better credits on the SPX than the SPY for some reason. You have to do a lot more contracts on the SPY. You know, you can do a 10 contract position on the SPX, get a really nice credit. You're going to have to do a lot more contracts on the SPY, so that's going to cost you more in commissions. So all things considered, we kind of do the SPX, and I do at least one trade every week on the SPX. The other trade is on a stock or in another index. Never trade options before. What are your recommendations? And that's from BC. I mean, get the education. I'm also coming out with a whole introductory course that I think you're really going to like on options. It's called Your Best Introduction to Options. You're going to love that. Do you ever offer auto trading with Thinkorswim? We don't. And the reason we don't is I want you to learn how to do this on your own. I mean, if I get hit by a truck tomorrow and, you know, our whole thing goes offline, I want you to be able to do this and trade from anywhere. And plus, it's fun. It's fun to learn. It's fun to do it. So one of the biggest compliments somebody can give me if they're a subscriber for like 3 years and they send me an email and they thank me profusely, but they say, hey, I know how to do this on my own now. I don't need you anymore. And I just congratulate them up and down. I feel like we've been a success when that happens. What was the cost per month? The cost is $97 per month, but we actually give some pretty good discounts if you want to buy, you know, a quarterly subscription or a yearly subscription. And once again, I don't want the cost to be a factor. So I want to make you enough money where it's just that cost isn't coming out of your pocket and you're not even worried about it. I bought the Winning Secret some time ago. How do I get it going again? That's a great question, Gerald. And you actually still got access to the education. You can call our office if you forgot your password or whatever. That education is for life, and we keep adding things to it. So there's a whole lot of new things in there that you haven't seen before that you're really going to like, but you still have access to that. And then if you want to get your subscription restarted, you can talk to us about that too. But anyway, I'd love to have you back on board. I'm comfortable with only 3 contracts. Can I still make money? Yeah, you can, VJ, and one of the ways that you're going to do that is you're going to talk to our team at Thinkorswim and get some commission rates where we can kind of waive that ticket charge. So if you're only trading 3 contracts, you can still keep a lot of your profits. So, you know, it's kind of designed for people that are just trading a small number of contracts. And as your account builds up, you know, you'll go to 4 contracts, then 5, and, you know, hopefully build up from that. Okay, my experience, win 10 or more trades and then huge loss, wiping out all your profits. How to stop loss, large trade losses. Okay, so that's from Gary. Gary, that's a really astute question. That, by the way, is the #1 complaint with credit spreads is I made money, did really good, and then this one thing wiped out all my profits. That's why we set those stop losses. That's why we do that. The other component of that, which is really, really, really important that a lot of people don't put enough emphasis on, is money management. You know, you just don't get yourself in a position where this huge reversal can, you know, wipe out your account. And I'll show you how to do that. I've got a really good section on money management inside the site that you have access to, and that's all included in the price. Do you have quarterly or yearly rates listed? They're on the website. Right off the top of my head, I know if you get a yearly, you get like 2 months for free. So instead of being, you know, close to $1,200, it's like less than $1,000. So a lot of people go that route, especially when they decide, you know, this is really the way they want to trade and this works for them. Does it include an intro for newbies? Yeah, we're going to give you some really good attention, BC. We're not going to leave you hanging, and actually individualized attention. So I've got Deanna that's going to be talking to you directly, and then we're going to have a coaching session. You're going to get your own individual coaching session with Alicia, and that's going to do you just a ton of good. What happens if you already have an account with Thinkorswim? Can you still get the same discounts? Yeah, we'll walk you through that. We'll tell you who to talk to and how to get that discount. We'd be happy to do that. Where's the performance listed? There's a track record like right on the public part of the site. Like I say, nobody else does that, but you can go to cashflowheaven.com. You can look at our track record. We're actually kind of proud of that. And I'll just tell you right up front, we don't win on every trade. And if we did, you probably wouldn't believe our performance anyway. But we do well enough to get people retired in 2 or 3 years. And I think that's kind of amazing. If the trade goes against you. Yes, are we out of time?
We are. I'm going to give you about 30 seconds to pick one more question and repeat your offer, and then we got to We got to switch gears here.
Yeah, if the trade goes against you, can you show how to repair? Yeah, I do that, and I'll send you information. And a lot of the time we'll roll down to lower strikes, or we'll go in the opposite direction. I show you all those adjustments. You know, I would actually love to spend another hour with everybody. You guys have great questions. I love these questions. I love people that are curious. This is a great way to trade. It's a great lifestyle way to trade, and the money is actually excellent. And you'll just be kind of shocked at how many times you win. So, you know, if you're a little bit frustrated, if the regular trading, directional trading that you're doing isn't working out exactly perfect for you, just really take a really hard look at this. I think you'll like it, and I'd love to have you on board. I think there's few things in life more fun than making money together. So thanks for being here. We got some great speakers coming up. I'm really excited that you're at this event. Really appreciate you being here and listening, and I'd love to have you on board. I'd love to make some money together. So thank you so much, and thank you, Jeanette, for having me.
Well, you're welcome, Peter. We're glad that you took time out. It's been a while since we had you on here. What better way to spend a Saturday morning than to listen to you guys talk for an hour? I feel good about it.
That's right. Hopefully you're not asleep.
I am not asleep. I sent an email out saying we were starting at 7:15 Eastern instead of 8:15 Eastern, so I had to get up earlier than I needed to get up to catch up. So
try it on the West Coast.
No, I won't, but thank you. All right, I'm going to dismiss you, Peter, so you'll